The Pact That Rewired Europe. It began not with fanfare, but with a signature scratched onto parchment behind doors closed to the public. A pact so unassuming at first glance that most citizens never even heard its name. Yet within its clauses lay the blueprint for a transformation that would ripple across borders, industries, and the very foundations of European finance. It was an agreement born from necessity, shaped by rivalry, and executed with a precision that few recognized until long after its consequences had taken hold. To understand how this pact reshaped Europe's financial trajectory, we must step back into a continent recovering from instability when currencies fluctuated wildly, trust between nations ran thin, and governments searched for ways to anchor their economies to something sturdier than political promises. Leaders believed cooperation could offer stability, but cooperation required sacrifice. The pact emerged as a compromise, part opportunity, part gamble, and entirely unlike anything Europe had attempted before. Today, its remnants still shape markets, institutions, and the silent mechanics behind cross-border wealth. The story begins with a handful of officials meeting in a modest chamber far from public scrutiny. Their nations faced spiraling debts, faltering industries, and markets growing weary of constant uncertainty. Individually, they were vulnerable. Together, they believed they could build a financial structure strong enough to withstand a storm. They envisioned shared rules, shared oversight, and a shared currency mechanism, ideas that felt radical in an era defined by national pride. Yet beneath their optimism lay a tension none could fully ignore. Each nation carried its own history, its own priorities, its own fears. Some demanded strict discipline. Others sought flexibility. All feared surrendering too much control. The pact they shaped reflected these contradictions. It promised unity, but only through rules that bound each signatory to a discipline it had rarely shown before. It offered stability, but only if every nation honored commitments that would test their political will. Still, the agreement moved forward. Early supporters hailed it as a turning point. Skeptics warned of consequences invisible in the moment, consequences that would emerge only when economies diverged or crises returned. But the pact was signed, sealed, and quietly set into motion, its frameworks woven into banking regulations, lending practices, and the invisible circuitry of Europe's financial network. For a time, the results looked promising. Markets steadied. Investors praised the new discipline. Cooperation replaced rivalry, at least on the surface. Yet beneath this early success, subtle fractures formed, small inconsistencies in how nations applied the rules, quiet disagreements over interpretations, early signs that the unity crafted on paper might prove harder to sustain in practice. Those fractures, though faint, were already pointing toward a future reckoning. For a pact powerful enough to bind Europe would one day reveal whether its strength lay in shared discipline or in the illusion of control. At first, the pact's quiet machinery seemed to function as intended. Markets stabilized. Currencies settled into predictable rhythms. Cross-border trade ticked upward as investors grew confident that Europe had finally discovered a framework capable of holding its divergent economies together. But beneath this veneer of order, the early signs of imbalance began to surface, subtle warnings that the pact's rules, though uniform on paper, were not being lived out in equal measure across the continent. In the financial ministries of several nations, analysts noticed that borrowing patterns were shifting. Some states adhered strictly to the pact's discipline, trimming deficits and restructuring old obligations. Others, encouraged by the newfound market calm, expanded spending more aggressively. They argued that growth would compensate for looser fiscal restraint. For a time, the markets rewarded this optimism. Yields remained low. Credit remained abundant. The pact appeared to deliver stability no matter how unevenly its rules were interpreted. But inside the institutions tasked with monitoring compliance, unease grew. Reports revealed divergences that could not be ignored, debt ratios drifting upward in some countries, investment levels stagnating in others, and competitive imbalances widening across the bloc. The pact demanded convergence. Reality drifted toward divergence. Officials debated how strictly to enforce the rules. Too much pressure risked political backlash. Too little risked undermining the pact's credibility. The uncertainty led to inconsistent decisions that only deepened the disparities. Meanwhile, banks across Europe adjusted their strategies to capitalize on the environment the pact had created. With currencies stabilized and borrowing cheap, they expanded cross-border lending at an unprecedented scale. Capital flowed freely from surplus nations to deficit ones, financing construction booms, large-scale infrastructure projects, and consumer credit expansions. On balance sheets, everything looked healthy. But the flows masked a critical vulnerability. Entire regions were becoming dependent on external funding that could reverse at the first sign of trouble. As these imbalances widened, tensions grew behind closed doors. Finance ministers exchanged terse remarks in private meetings. Some accused their neighbors of exploiting the pact's stability without honoring its discipline. Others countered that the pact itself was flawed, too rigid for weaker economies, too lenient for stronger ones. The unity that once seemed within reach began to look more like a fragile truce. Yet the public saw none of this. Newspapers celebrated rising prosperity. Politicians touted improved credit ratings. Citizens embraced cheaper mortgages, greater mobility, and new opportunities. The visible world suggested a Europe marching confidently into its future. Only those closest to the ledgers sensed what lurked beneath, risks accumulating quietly, silently, steadily. Then came a development that few outside expert circles noticed, a shift in global markets that altered the cost of capital. The change was modest, but its effects exposed the fragility of the pact's internal balance. Countries that had relied on cheap funding suddenly faced rising refinancing costs. Projects once viable under lower rates now strained budgets. Banks re-evaluated their exposures. For the first time, the pact's weakest participants felt the pressure of obligations they could not adjust and rules they could not escape. Inside oversight committees, concern sharpened into alarm. The warning signs were no longer theoretical. They were material, measurable, growing. The pact had succeeded in creating stability, but at the cost of masking imbalances that now threatened to surface all at once. Whispers circulated through the corridors of Brussels and Frankfurt: if the divergence continued, the pact could face its first true test. And when that test arrived, even the most disciplined nations would discover how deeply their fortunes were tied to their neighbors. The first true test arrived not with a dramatic crisis, but with a slow tightening that only those closest to the numbers recognized. As global markets shifted and borrowing costs crept upward, several pact members found themselves struggling to meet obligations that once seemed routine. What had been manageable under low interest rates now pressed against national budgets like a rising tide. The pact's rules, once praised as guiding principles, began to feel like iron restraints. Inside finance ministries, late-night meetings became routine. Advisors warned that debt levels, long tolerated, long explained away, were now becoming unsustainable. Projects launched in years of easy credit suddenly appeared overextended. Revenue forecasts dimmed. Yet the pact allowed little room for maneuver. Nations that needed to spend more to revive their economies were required instead to tighten further. Those that had grown accustomed to external capital now found its price climbing, its availability shrinking. Banks across Europe sensed the shift immediately. They began reassessing their cross-border exposures, mapping out which regions were most vulnerable. Some institutions reduced their lending quietly, unwilling to spook markets. Others demanded stricter collateral. Even subtle changes in their behavior rippled through economies dependent on their credit. Businesses felt delays in loan approvals. Homebuyers encountered new requirements. Local governments found it harder to fund essential projects. Tension, once theoretical, became tangible. As strain increased, whispers of non-compliance reached the oversight committees responsible for enforcing the pact. Certain countries had begun bending the rules, stretching deficit limits, reclassifying expenditures, searching for technical loopholes to avoid penalties. These tactics were not new, but the scale and frequency now troubled even those historically sympathetic to flexible interpretation. The pact depended on trust. Trust depended on discipline. And discipline was slipping. Behind closed doors, disagreements grew sharper. Some leaders demanded strict enforcement, arguing that bending the rules would undermine the pact entirely. Others insisted that without flexibility, struggling economies would suffocate under obligations they could not meet. The divide exposed a deeper philosophical conflict. Was the pact a shield for collective stability, or a tool for enforcing uniform behavior? No one could answer definitively. But everyone understood that the divergence was reaching a breaking point. The warning signal came from a mid-sized nation whose finances had quietly deteriorated. A routine debt auction failed to attract sufficient buyers. Yields spiked. Credit agencies issued cautious statements. The nation's bonds, once considered safe within the Pact's protective umbrella, became symbols of vulnerability. Markets reacted swiftly. Investors questioned the solvency of other member states. Banks re-evaluated their capital buffers. Fear spread not loudly, but efficiently. In capitals across Europe, leaders felt the shift instantly. They understood what history had taught them: crises within integrated systems do not remain isolated. They move fast, unpredictably, and with consequences far greater than their origins. The pact that once promised unity now bound nations together in uncertainty. The fate of one had become the fate of many. Pressure mounted for immediate action. Emergency meetings were scheduled. Central banks prepared contingency plans. Advisors drafted communiques meant to reassure markets, though few believed words alone would suffice. The pact had entered the phase its designers feared most, a moment when stability depended not on rules written years earlier, but on decisions that had to be made now, under duress, with no guarantee of success. And as the crisis deepened, one truth became unavoidable: the pact's greatest strength, binding nations together, had become its greatest vulnerability. No country could navigate the storm alone. But whether they could withstand it together remained uncertain. The reckoning was no longer approaching. It had arrived. The reckoning took shape in a single, electric night, one that stretched across boardrooms, parliaments, and central banks as Europe confronted a crisis no longer containable. The mid-sized nation whose debt auction had failed now faced an imminent liquidity freeze. Banks within its borders teetered. Payments were stalling. Confidence, already fragile, began to fracture across the continent. What the oversight committees had whispered in private now erupted into full view: the pact's stability was at risk. Leaders from the pact nations were summoned for an emergency summit. They arrived under the weight of history, knowing the decisions made in those rooms would determine not only the fate of one struggling country, but the credibility of the entire agreement. The air buzzed with urgency as advisors circulated fresh data: bond yields climbing, cross-border credit lines tightening, capital outflows accelerating. Waiting was no longer an option. Action had to be immediate. The debate was fierce. Some leaders demanded strict adherence to the pact's rules, arguing that bending them would undermine the very discipline the pact was built upon. Others insisted that exceptional circumstances required exceptional measures. Without intervention, the crisis would spread to banks, pensions, industries, and households across Europe. Stalemate loomed at the worst possible moment. Finally, in the dim hours before dawn, a compromise emerged. The pact nations would create an emergency stabilization fund, backed by collective guarantees, to support the failing country's financing needs and shore up its banking sector. In exchange, the struggling nation would accept oversight stricter than anything previously imposed. The pact would not break. It would bend under supervision, under pressure, and under the recognition that survival required flexibility. When the announcement was released, the markets reacted with cautious relief. Bond yields fell. Credit spreads narrowed. Banks steadied their positions. Europe exhaled, slowly, uncertainly, but with the recognition that a collapse had been narrowly averted. The pact had endured its first true crisis, though not without revealing its own fragility. In the months that followed, reforms reshaped the agreement. New mechanisms for fiscal coordination were implemented. Oversight grew sharper. Transparency improved. Nations that once treated the pact as a distant framework now understood its weight intimately. They recognized that shared prosperity required shared responsibility, and that unity demanded more than signatures on parchment. But the crisis left scars. Citizens questioned the cost of the rescue. Critics argued that the pact now carried obligations voters had never anticipated. Supporters countered that the intervention had prevented a catastrophe far greater than the sacrifice made. Europe moved forward, but the memory of that night remained a reminder of how quickly trust can erode, and how essential cooperation becomes when systems are tested. The pact that rewired Europe endured not because it was perfect, but because its members refused to let it fail. They confronted its weaknesses, adapted its rules, and accepted that unity requires constant vigilance. Its story is not merely one of crisis, but of resilience, the kind that emerges when nations face the truth of their interdependence and choose to build something stronger from the pressure. Subscribe to join the journey.